Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod. Thank you, as always, for choosing to spend your time with us today. Real quick, before we jump into today's show, if you haven't already, please subscribe to the podcast to ensure that you don't miss any of the amazing conversations or content that we put together and release right here every Wednesday on your podcast platform of choice. Today, I am really excited to share a conversation with you that I recently had with Dusty Clevenger of Ascendant Partners. Ascendant Partners, for those that may not be aware, is an investment bank and advisory firm that's dedicated to helping agribusinesses, renewable fuel businesses, and food companies protect and enhance value, which ought to sound very similar to a lot of the topics that we talk about every single week here on the show. Now, Dusty and I came to know each other a few years ago, and we've spoken several times over the last couple of years to kick around ideas and share what trends that we're watching, what our clients are navigating as they execute strategy in pursuit of growth, and then more recently, what agribusinesses need to be thinking about in the uncertain markets that you all compete in today. And so, of course, he makes for a great addition to what we do here every single week on the Pacesetter Pod. And Dusty was kind enough to agree to join me on today's show. Dusty's going to walk us through his formula for growth success in agribusiness, which is a nice, simple framework to make sure you're not missing any of the major elements for both successful transactions via M&A, but also more generally just executing a proper, rigorously tested and execution-ready growth strategy. We'll talk about the outcomes and rewards that you can expect from getting it right when you do all those upstream activities the right way, and also what you need to be preparing for in the next 12 to 24 months of what is expected to be a very turbulent market that's still going to present some meaningful opportunities for growth if you're execution ready and you've got a clear-eyed view on where you're going. I really enjoyed this discussion, both for its timeliness in the market that we're in right now, but also for how insight dense it is. And so with that, here's my conversation with Dusty Clevenger of Ascendant Partners. Dusty, good morning. Welcome to the Pacesetter Pod.
Good morning, Joe. Good to be here. Thank you.
Very much appreciate you taking the time from a busy schedule and what I assume will get busier yet, given the current economic environment. Dusty, one of the things that I've come to appreciate from the conversations that we've had in our work that has some adjacencies and a little bit of overlap is the structured, pragmatic approach you take to evaluating opportunities for growth, both relative to transactional growth, meaning M&A or even divestiture, but also growth just by thoughtfully looking at what the opportunities are the market might provide. And you've actually codified this in a formula for growth success framework. And I think it'd be great for us to maybe just kick off by having you walk us through what is your formula for growth success. What are the things that you look at and what are the elements of the process that you take your clients through?
Absolutely. That's great, Joe. Before I dive into that, I want to say I've been a long-time listener, first-time caller, if we can still say that. So I love this podcast. I know you're over 100 episodes in. You deliver some great wisdom to the industry. And just from an industry seat, Joe, I want to thank you for consistently doing this. I think this is an awesome service you do for the industry. So I appreciate this. And it's great to be here. So thank you.
Well, thank you.
So yeah, that formula for growth success, over the last couple of decades, I've been involved in a number of growth opportunities, capital raising, transactions, selling stuff, buying stuff, building agribusinesses. And as I kind of put my whiteboard notes together on what makes for a successful growth opportunity, there's really been kind of 5 key things that, from my view, all have to line up. And, you call it this formula for growth success. It's kind of, what we use internally to look at opportunities. So, and what they are is, there's 5 pieces. 1, does the market present an attractive opportunity? So is there a need in the market to do this thing we want to do? Does it fit strategically with my company? So is there a market need and does my strategy align with fitting that need? Do I have the internal capability to actually execute on this growth? And that means a lot of things, from talent to systems and all those kind of things. Do I have shareholders that support this? So is adequate capital available, or could it be available to support growth? And then finally, the fifth one is really if I'm going into more of a merger or an acquisition, do I have a receptive counterparty on the other side? So am I going to be able to do this at a market, a fair market valuation? So thinking about those five things, if the market says here's an opportunity, if my strategy says it's kind of where we want to go, if I've got the internal capacity to pull it off, my shareholders and my counterparties are aligned, if all those are green, you've got a good chance of a successful deal.
Yeah, I like it. So let's maybe dig into each one of those independently and then kind of how they coexist. Because I also, living in the real world, we know that it's not a linear process whereby you're doing one before you do the other. They're all existing at the same time, perhaps in alignment with one another, sometimes in conflict. But starting with the market opportunity. So looking for, let's say, an unmet need, an emerging opportunity, a segment where folks have maybe underinvested or failed to appreciate the value creation that is there. What is the approach to, evaluating that, codifying that, and really how crisp do you get at defining the market opportunity before you start thinking about, okay, does that opportunity, as rich as it may appear, actually align with our strategy, which of course is step two?
Yeah, I mean, when I think about this, the market opportunity is really the main external to my company piece of this strategy. And there's, lots of ways to just read the market. I've done a lot of work at, you attend conferences, you listen a lot to what's happening. That's probably the number one thing in understanding the market is you listen. It's very important to read the data. So I think in ag, we oftentimes, put a lot of faith in our gut, which has a lot of value. When you're thinking about the market, there's both the technical and fundamental things that present opportunities. So is there, pieces of information, reports, data that you can read that help to understand and see those opportunities? And then when you're in conversation, you ask good questions. And oftentimes I've found that opportunities come from what my customers have asked for, what my competitors are maybe steering away from or looking at. But it's really, you ask the question, does a market want something to happen here? Like you said, Joe, is there an unmet need? And is that something that, I can find synergy in executing? If there's, a 1 + 1 = something bigger than 2, that's a synergy opportunity. So in my analysis of data, in my listening to the market, I used to have an advisor that said he would listen to the jungle drums kind of beating. You kind of get the sense that something's coming. You get that feeling, you prove it out with data and what you read and what you hear.
And you've been both, well, we'll talk about your background in a bit here because I think it's really interesting. But you've been both an inside guy at large incumbent organizations in agribusiness. You're now, as an outside advisor to some of those same companies and also companies along the size and scope spectrum within our industry. There's this inherent sort of potential for conflict or friction when we consider what does the market want to have happen, what is aligned to our strategy, which is it's so obvious when you say it, right? Do things that are aligned to your strategy, and how often we sometimes don't, or our strategy is so broadly defined that anything fits in. But if those two things have strong connective tissue, the market wants this to happen, it's aligned to our strategy. But what about those cases where maybe it's not aligned to your strategy, but your ability to execute? So that third element of, are you execution ready? Could you actually pull it off, right? Which is a really great, litmus test for any sort of investment opportunity or things you choose to pursue. What if the market wants to happen, but it's not aligned to your strategy, so you're not spending any time looking at it? But in fact, if you really were to reverse engineer your business, you'd say, man, we are in the prime position for executing this. How do you coach folks to keep an open mind such that maybe there is something that should be aligned to your strategy because your strategy should shift to meet this opportunity, if that makes sense?
Yeah, that's a great question. It's like, people say strategy and it can mean lots of different things. It surprises me how many companies think they have a strategy, but they really don't. They haven't really thought about, why do we exist? What's our reason for being as an organization? Sometimes you go through an exercise and you create this strategy and it gets put on the shelf and it kind of sits there and you forget it's there. But yes, we've got a strategy. I could pull the file out and show you sometime. I think to your question, Joe, when you see this market opportunity and it's something that, is generally in your space, you have the capability to execute, but maybe it doesn't fit the strategy. It's where you need to think about how alive is my strategy? Has my strategy become stale and I'm becoming irrelevant in the market? Am I kind of losing my position? It's not to say I'm going to completely reinvent my company, every quarter when a new opportunity presents itself. But strategies are meant to be a living thing where you have a vision, kind of a reason for being, but the way you execute that vision can change over time based on what the market tells you it's rewarding you to do. So I would say the biggest thing is, how do companies keep their strategy alive and keep their strategy relevant to what the market's showing it is available?
Yeah, I think it's almost fighting off calcification between your ears, right?
That's right.
Let's not stay too rigid and maintain that agility. As a brief aside, I know a gentleman that used to own and run a company that was one of the preeminent OEM manufacturers of the machines that make pallets. And you talk about, like, on the surface, one of the unsexiest businesses you can imagine, right? But the world moves by pallets. Yep. Pallets are then in the trucks, they're in the containers, they're in the vessels, they're in the rail cars, right? They're in the warehouses and everything. And pallets, they are always produced onshore, without exception, because manufacturing and shipping them, you'd be shipping a lot of air, a lot of dead space in your units. One of the things is as their growth curve matured, they had to think very creatively about where is their competitive advantages, and it landed in, well, what else has to be produced onshore without exception, because otherwise you'd be shipping air. And they started to arrive at things like box springs for mattresses. So it was an adjacency, and I think it's important to say, okay, look, if the market rewards this thing and we have the ability to do it, that actually should be a good trigger for you to go back and not just use your strategy as a alignment checkpoint. Does this align? Yes or no? Screen it in or screen it out. But actually say, is our strategy, to your point, alive and flexible and evolving enough to reflect the opportunities in the marketplace? Because maybe your business does need to look radically different. And Absolutely. There's just one or two things that you can do that no one else can do as well as you. And that's where the future is.
Yep. Great point. Yeah. And Joe, we've seen a little bit of that, even in the last number of decades in just the grain handling business in the U.S. It used to be way back in the day, large grain elevators were built to store a big harvest and piece it out over time to the domestic market. So storage was paramount. Today's grain business is different. It's less about storing grain and more about facilitating the rapid movement of grain when the market asks for it. So today we reward speed more than space, whereas, 30, 40 years ago, we rewarded space more than speed. And it's just an example of, the purpose of the local grain elevator is to service the farm community and provide market access for their grain. But the way that they've delivered that service has changed just in the time that, we've been around the industry. So it's things like that where you compare what the market's showing you with how you execute your strategy and your reason for being as an organization. Absolutely.
I want to dig in for a moment on strategic fit, which I know I kind of nibbled on the edges a bit. And this is to your point around how the market does evolve and the role you play in the marketplace changes. So when a fictional owner operator of an agribusiness has looked and has said, okay, actually this is an opportunity in the market. This is something the market wants to have happen. I'm going to do the strategic fit check. And let's also presume for this example that person actually does have what we would define as a strategy. Mm-hmm. And it's not the daylight that exists between mission and vision and your annual plan, which is often where the strategy should sit. How rigorous, how scientific is the exercise of evaluating strategic fit? And or from your perspective, what is the ideal amount of activity there? Because I've seen organizations that actually, they have a 5 or 7 factor checklist of saying, these are the things that we want to invest in. These are the particular geographic areas. These are the product lines. These are the customer profiles. These are the demand markets, whatever it is. And if it meets 4 out of this 5 criteria, or we evaluate against these 7 factors, or et cetera. And if it meets those, that's how we're actually going through and checking it line by line, almost an audit.
Mm-hmm.
Where in others, it's a facilitated meeting of management. Maybe the board gets involved and it's more of a gut feel, right? And so I think both have some problems. You don't want the spreadsheet to make the decision for you, nor do you want 12 guts maybe making the decision on the future of your business. So where do you draw the line? What does strategic fit in action look like?
Yeah, that's a great question. And to your point, Joe, I think it's a little different for the culture of each organization. But, generally for me, as I've seen that process, the more clear and consistently communicated and understood the strategy, the less time it takes to understand, does this fit or not? It's kind of like when you go to buy a house, you walk into the house you want to buy, you just kind of know, because you've got your criteria for what you want in this house. And when you walk in, you just kind of know this is going to be my next home. If you have a really clearly defined strategy, and it's less about the nitty gritty details of a business plan, but strategically, which direction are we going and why are we going there? And you see things that come across your desk that are right down the fairway, it's really easy to say, that's where we're going. And now it's more about, the terms of how we execute that growth that decide if we actually move forward or not. So the decision to move forward or not is usually pretty straightforward, because if you have a good strategy, this is where I want to go, so that you're not bogged down by that analysis paralysis that can happen. Mm-hmm. And you end up missing opportunities. Staying nimble and flexible, knowing your strategy helps that process go fast. So I tend to lean towards less time than more to at least get started and begin the process of, is this something I want to move forward in? And I think companies that do that outmaneuver the competition, and they get rewarded for that.
In the context of an acquisition, do you tend to try to consolidate those down or synthesize those into a few expected outcomes that could be measured at that stage, or does that come later? And the reason I ask is, when we get involved oftentimes around, planning for post-merger integration, and we might get involved at the time an LOI is signed when diligence is just starting. More often than not, diligence is well underway. There's pretty good sense that this is going to close. Now we start worrying about integration. We bring them in. And one of the first questions we ask is, okay, well, why are you doing the transaction? Let's make sure our integration plan reflects the reasons that you're putting your cards on the table and that you're placing this bet. And sometimes not always, but sometimes there's a lack of clarity around specifically what is the outcome that'll define success and how are we going to measure it. And so I'm just, from your standpoint, at the moment of determining strategic fit, is that also when you determine the expected outcomes, or is that still to come as you get into negotiating with the counterparty, diligence, closing, et cetera? Where would you place that level of specificity?
Yeah, that's a really interesting question. So when I think about, kind of the life cycle, if we think about M&A, and it's probably similar for a growth CapEx project, think about M&A in particular, because usually there's a time element associated with it. There's competition around it. So you kind of have to keep up with the cadence of time. So at the outset, when you first kind of come across an opportunity, it's less about the desired outcomes and kind of what does this thing look like a year or two from now. It's more about, is there enough interest in this idea, this opportunity, for me to begin to invest some time to figure those things out? So when I think about the process of a deal, we usually talk with people about an initial diligence period and then a full diligence. And the initial diligence is usually where you don't spend any hard dollars. You just spend some thought time going through, does this fit strategically where our business is headed? If we make simplifying assumptions that, financially it's going to be a good return, we can actually make money putting capital to work here. If we make the assumption that, to the fourth thing or the third thing, we have the internal capability to pull this off. But at the outset, does this fit our strategy? If the answer is yes, then we begin kind of more of this robust diligence period where you start to answer those questions where you're coming from, Joe, of, how do we execute doing this deal? How do we execute the, kind of campaign promises along the way? Once we've caught this thing, how do we actually integrated and make money with this.
Mm-hmm.
And you begin to fill in the execution plan at that point. But early on, it's more about just, does this fit? Does this align with the strategy that we've said and agreed to with our board? And then you start to fill in those details with time.
So fictional seed company looking to buy another independent seed company in a new geography with some different genetics, some different branded products. And, the strategic fit is, well, we wanted to expand our sales into this particular part of the country or this continent, et cetera.
Mm-hmm.
Ideally via distributor, for example, versus direct to grower, depending on what the company's strategy is. So you've got that sort of this on its face would allow us to access that market and also do so via a channel that aligns with our future vision. And that might be, that's not enough, but for this mental exercise, that's enough. In the full diligence, you actually say, okay, what would we expect customer retention to be over a 12 or 24 month period to define success? What sort of penetration are we looking at via how many distributors we have access to? That's where you would actually start to define the specific metrics by which you would measure the near-term success of that acquisition and the subsequent integration. Am I thinking about this correctly?
Yeah, absolutely. And part of the reason you defer some of that is there's so much work that goes into creating that successful full package that you want to show progress along the way that I'm moving. And at any point during this continuum, you can say, it's not for me. I've gotten to a point where, the lights are no longer green. I see some flashing yellows, or I've got a solid red, and it's time for me just to bow out. And that's okay at any point in time. But to keep moving forward, to answer some of those questions, you need to really, get in the weeds and understand exactly what the customer profile looks like, understand exactly what the genetics are like. There's things that you don't know for the detailed planning, but from the strategic point, this is an area I want to investigate more. So yeah, over time, you answer those questions as you learn more. And I think, one thing that is really valuable is, and I forget the exact term, if it's thinking gray or, trying to defer decisions as long as possible. The more you can hold a hypothesis as a hypothesis until you really prove it out, the better. And I think if you try to answer questions too early, you end up becoming, more rooted in something that may not be true. And it could end up, causing some bias in the process. So the more detail you get, the further in the process you go, the more information you have, the better decisions you make. So really try to defer firm decisions until you get later. Even things like, how are we going to manage success? Until you really understand the opportunity, you may not really know how to measure it, other than, I want to make sure that this is financially accretive for my shareholders. That's always, important. But how you get to that point, it could change across the continuum of the deal.
Yeah, certainly. The opportunity may be bigger than you imagined. It could also contract considerably. So then on that mention of your shareholders there, and part of your model is, of course, ensuring stakeholder, shareholder alignment and support. It's shareholder, not stakeholder here. And being able to access the capital, the financial capital, as well as the social and political capital of the board, et cetera, and your lenders to actually execute the deal. I would assume, and I don't want to say that's an easy step. Raising capital is not easy by any means. But I would assume that if you have rigorously and robustly gone through those first three steps of validating there's an opportunity here that the market is presenting, ensuring that's aligned to your pre-stated strategy, being clear-eyed about the fact that we think we can execute this, we have the chops to pull it off. When you actually bring that forward in the form of a capital request, whether that's for reinvestment in existing facilities, greenfielding or brownfielding something, buying a business, whatever it is, I'd presume that if the work that you do up front sort of greases the skids for that fourth phase. But maybe tell us about that process of actually taking an idea through those first phases and matriculating it through to actually getting the capital and the board support to pursue it.
Yep, absolutely critical. I think in terms of the first three pieces, your shareholders are going to be or should be very involved in this strategic piece. The strategy of the firm has to do with, what do the shareholders want to happen? So why are they shareholders in the first place? So if they agree with the strategy, they've been along for the whole development of the strategy, so they understand the strategy as much as the management team. That's why they're shareholders and investors. Our job as managers is to make sure we have the internal capability and we're watching the market to read the signals to see the opportunity. So when it gets to the point of, do the shareholders support this and will they pay for it? It's pretty simple, to your point of kind of greasing the skids, where they understand the strategy and how it fits, and they understand that we can pull this thing off. And a really important part of this kind of deal process is frequent and, clear communication as much as possible with your shareholders so they don't get surprised. So typically, again, if we think about like an initial diligence and a full diligence and LOIs and kind of the full deal process up to financing and close, most companies that I've worked with or worked for, as soon as you kind of have something come across the bow that looks like it fits, you're starting to communicate that with your shareholders. Hey, there's this opportunity to expand our seed business into this new region we've been talking about. This is kind of what it looks like. We want to start to pursue this. Just want to give you a heads up that we're looking at this because it fits the strategy we've been talking about for the last 2 years. As that opportunity matures and you start to answer some of those questions, your shareholders are brought along the whole way up until the point of, now it's time for me to formally request approval to do this deal, the commitment of capital. Maybe we don't have all the capital and we have to source some other funding to kind of make this happen. How we actually execute is where the shareholders get really interested and excited about kind of putting the final stamp on it. But by the time you get to that point, they kind of know all the pieces because they've been a part of it. The last thing or the worst thing you want to do would be to surprise them with something where you've fully developed this, 50-page plan that's very detailed and maybe a perfect plan, but they haven't seen it coming. That's when things get denied and you miss opportunities. So communication, I think, is the most important thing. And at the end of the day, one thing that I learned is the golden rule kind of early in my career, that he who has the gold makes the rules. So at the end of the day, it may be the perfect market opportunity. It may fit strategy and they have the capability to do it. But if your shareholders don't want to go that direction, if they've changed their mind on strategy, they can always say, this isn't what we want to do with our company.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
I think so. There's a lot of wisdom in that. The one thing I would, caution for listeners, this requires healthy and properly managed governance, because boards that are actively engaged in the business, that are, that lean in when there's an opportunity to grow, that are actively interested, that, business acumen, that are, they're there for a reason and they're there to do their job. Those first preliminary, we're looking at this thing. We're looking at this acquisition. We're looking at this opportunity for an alliance. We're looking at investing in some capital in this particular area. We want to give you a heads up because in 6 months, we may come back with a capital request and we're going to update you every month or every quarter between now and then. Mm-hmm. That can also generate a lot of preemptive questions from a board that perhaps doesn't, between board and management that haven't clearly defined the roles and the expectations around what that communication is. And so, there's always the risk that if you don't have that properly defined, what you just said around, hey, we're giving you a heads up, we're going to be working on this thing. We think there's potential, but we want to validate that before we bring you closer, could also invite not scrutiny, but a ton of questions and things that frankly could suffocate how quickly you can move through your analysis. And so I think as an executive or an operator, when you start to experience that of, guys, we just said we're just looking at it, don't ask me about the IRR. That's probably a signal that there's a governance opportunity to refine how you're working together. And that's also going to be really important for getting full-throated shareholder support, is to make sure that that's working well.
That's Excellent point, Joe. And that's a whole nother podcast on kind of governance and management, because you're to your point, it's different. If you're an owner, if you're in the governance side, or if you're a manager, all of those are different roles on purpose. And if everybody's operating as they should, and if it's a healthy organization, you can be very successful. But you're right. Oftentimes those roles are not fully defined. And particularly if you're not in the cadence of regular growth, if this is something that's unique or new for you, you're going to have to build some muscles that aren't there today. And building those muscles and making that identification early is definitely going to help. So very good point.
Yeah. The well-intentioned but poorly timed level of questions can torpedo a lot of really important work. One last question here before I think it'd be good for us to hear more about you and Ascendant Partners and the work that you all do. Much, obviously wrapped around what we've just talked about for the last half hour. So we take this formula, if you will, or this framework, and a disciplined owner, board, and management walks through, validates that all these things are true. How does the market react? And I mean, if you get this right, how will you be rewarded? Because I think it makes intuitive sense, but are there meaningfully different outcomes that we can point to from organizations that would actually follow a framework like this?
Yeah. Yep. Well, obviously you're successful in growth and your business grows and there's financial, growth that comes from that, all those kind of things. But I think, aside from that, if you're in the market watching companies that do this really well, there's a couple of things that I think come to my mind, Joe, and I guess they would be, confidence is maybe one. And that means a lot of things that I can just talk about for a second. And then the other one would be visibility. You're going to see a lot of other things that you start to kind of create your own weather around growth if you do this really well. So thinking about confidence, everybody wants to back a winning team. And businesses that execute growth well, that are, like we've been talking about, kind of well-oiled in their growth machine, they're the businesses that vendors and contractors want to come do work for. They're the businesses that employees are attracted to. So you get some really great talent that wants to think outside the box and be a part of that growth. They're the ones that, honestly, sellers want to do transactions with because they know that they're going to have a good counterparty on the other side that kind of has their pieces together to execute the deal. And then, importantly, particularly, we're talking about oftentimes some pretty large capital transactions. They're the ones that banks want to lend to. So you kind of create this confidence that decreases your cost to execute and increases your opportunity because there's that confidence around it. And then with the visibility, you're in the flow. When the market sees you as a business that is focused on growth, that executes it well, you start to see more and more things all the time. That strategic clarity and proven track record, it's opportunities. I had an investor advisor once that would talk about buying snow shovels in July. So if you think about businesses that do this well, they get to see the opportunities to buy the snow shovel in July before winter's here because they know winter's coming. And part of that is you do it well and you have the visibility to see it with the confidence of the market that this is somebody we want to do business with. That's, like I said, you kind of start to create your own weather around this is the company that everybody wants to get behind because they're growing and growing really well.
Yeah. So one thing I want to thread to pull on there, I think to your point around the confidence and the visibility and kind of how they wrap together, you're effectively, when you show that you can do it well, the one, you can do it, binary yes or no. Did you actually pull off let's use a transaction at this point? Did you get it across the finish line? 2, did you handle it appropriately? And 3, was it a value accretive event once you look back in the rear view over time? That effectively de-risks future transactions for your lenders and for your capital partners that are going to invest into those things. But there's also something here, and I don't want to say this is specific to our industry, though we know it's very much true in our industry. Whether it's a co-op that's been around for 100 years and is a creature of merger, but still has those roots of its original, original establishment, family-owned, multi-generational companies, independent dealerships, all these folks that are They need either a liquidity event to exit that business. There's not a succession plan in place. They know they need the capital to grow, and the only way that's going to happen is through merging to become part of a larger organization. All of those things still, they have an expectation that you're going to be a steward of their legacy and a steward of the value that legacy has represented. And I think that you also are de-risking it, like you said, for the sellers. And this is probably a tough thing to measure, but if you could do things today that 5 to 10 years in the future make you the first call from the best sellers on the market, bestseller meaning the most disciplined, the most ready, the most culturally aligned, that have the best opportunities for growth, being on the short list for those folks is a huge leg up over the long term. And defining bestseller is pretty tough. Everyone thinks that they're a great seller, and also everyone thinks that they're a great buyer too. But I think that's de-risking it for your lenders and for those future sellers is a really important piece.
Yeah, I agree. I love that you bring up the word stewardship because there's, when you think about kind of the process of a transaction, actually doing a deal is pretty easy. You just kind of do the deal, you sign the paperwork, you write the check, the deal's done. You and I both know, Joe, that there's all the evidence out there of how many of these growth opportunities that end up being failures because they don't deliver on the value that was promised. So that, and you said it there, the ability to do the deal and also execute on the opportunity and the synergy that could be there financially is important. But I think probably more so in our industry, the stewardship piece of this is almost as important. So there's always price and kind of terms of a deal, and protecting and honoring legacy and stewarding the supply chain. I mean, we're in a noble business in agriculture. We literally create food that feeds people and creates fuels and helps people live. And stewarding kind of this industry that we're in, we're only here for a brief time. And how we steward that through these transactions that should make the system better is a really big deal. And even if you're a mom and pop business that dad's retiring, nobody wants to take, and it's time to sell my family business, that's a legacy thing. Or even if you're one of the big majors that is carving out one of their divisions, they still want to make sure that division is healthy and goes to a healthy buyer because it's got a role in the marketplace. So
that's right.
Proving and showing and demonstrating through transactions that you're a good steward is critical. And it gets you those looks where you're able to do deals faster, better, cheaper. You spend less time, in the negotiation and competing phase. So it's faster for you. There's lower costs and you end up with better opportunities because you get to see so many of them and you get to be more selective in those that you find. So there's a lot to that. So I'm really glad you use that word stewardship.
Yeah. And for folks that are maybe, first time acquirers, let's say, or first in a long time acquirers, and Dusty and I have talked about this offline before, doing a transaction, and much less doing a transaction well, is going to beget, additional transaction activity or interest. So for anyone listening who has done, let's say you did your first transaction within your multi-generational family-owned business in the last 5 years, that the next 12 months after you announce that close, the inbound volume from brokers, bookmakers, potential sellers, trying to gauge your interest in another one, it goes up considerably. Now, whether or not that's a trailing liability or trailing asset for your business, that's up to what you're trying to do. But just know that doing the first one and getting it done almost certainly begets additional phone calls.
Absolutely.
Dusty, you've had an interesting background. Maybe we should take a few minutes here. This would be a good time to, walk through the work that you've done for our industry, where you've done it.
Sure. Yeah. So I was born in the ag space, Joe. I love it. My career, my life is focused on ag, and I'm going to die in this industry. So I am an ag person cut from the cloth. So, my background, I've got, I'm from a rural background in Nebraska. I've got almost 25 years experience in everything from commodity merchandising to, business analytics to M&A growth and capital projects. And so I've done a lot of those kind of things across a variety of platforms, from multinationals. I started my career with ADM to private equity as part of the Gavilon buildup and that sale a number of years ago, worked in Europe, South America, the US. I've seen a lot of different perspectives on the industry. And then a couple of years ago, I had an opportunity to kind of step to the other side of the table where I am today with Ascendant Partners. We're a boutique ag investment bank. And I love this role with this group because we get to kind of be in the middle of everything that we're talking about and trying to connect supply and demand of just deal flow and things that try to, again, steward the industry and facilitate deals that get the industry into a better place. So just briefly about Ascendant Bank or Ascendant Partners, we're a 20-year-old boutique investment bank exclusively focused on ag. And we define ag as kind of your traditional agribusiness, grain handling and merchandising operations to renewable fuels to kind of first level food processing. We like to say we're in the middle market. So opportunities that are kind of below that $20 million transaction value are a little too small for us to spin up our machine, up to, transactions that are in the 500 to 600 million range. So that's our sweet spot. We do kind of 3 lines of business for us. We do advisory, which is kind of that formula for success, kind of going through those pieces, helping clients understanding where they are and where they could get to. So that's an advisory piece. And then oftentimes advisory will lead to either a transaction, an M&A transaction, or a capital raise. We are a FINRA-registered broker-dealer, so we have access to a variety of capital markets to raise funds for people or represent them typically in a sell side. We've got a team of 8, so we're small, nimble. We're spread out across the Midwest from Kansas City, where I am, to Denver, to Omaha, Chicago, and soon we're going to have one of our guys in Houston. So we try to, kind of cover the main areas we have people in market where our clients are. And
do you advise on both the buy and sell side when it comes to M&A?
Yep, we do both. Typically, we get involved on the sell side, but we do both pieces, yes.
And I think what I want to highlight here for our listeners too is, folks like Ascendant, this is not universally true, but there is often the case where you have folks that are expert on the advisory side and supporting a transaction, but are not part of the underwriting or raising capital, accessing capital for the deals. Conversely, you have a lot of folks that are really good at the capital raise side and underwriting deals and helping build that book of capital partners, but they might not be so much on the advisory side. And beyond maybe just the closing mechanisms of a transaction, they're probably not going to be steeped in diligence, things of that nature. And so, again, this is not universally true, but that's often a bifurcation that you can expect. And so I think one of the things that's interesting about you guys, Dusty, is that you actually do that full suite. And so for folks that might not even ostensibly need to partner with an investment bank to evaluate and execute against growth opportunities, you still have something of value to offer to them.
Yep,
as
absolutely.
Well as the folks that have got the in-house corporate development and they've done a lot of the work up front. And frankly, they need an external, qualified, credible partner to help facilitate the actual transaction and ultimately, funding it. So there's a little bit of something for everybody there, as well as, of course, the full suite for folks that need a little bit of it all.
Yeah, we like to think of ourselves just as an extension of, our client's bench. Like you say, sometimes they have some internal capabilities, but they need to scale up a little bit to get something done. We're part of the scale up, or sometimes they don't. And we just come along and kind of bolt on as this growth piece. The other thing that, having been a client on the client side for most of my career, one thing that I really like about Ascendant is that we're in and from the industry. So we have people that have been in ag banking and ag private equity. Myself in the commercial and operations side, we've had people from, family offices that are focused on agriculture. So we're all cut from the cloth of the industry. So it's a little different look and feel when you come to Ascendant, just in terms of kind of how we engage with you. And I think, really putting this stewardship, back to that word, putting that in the forefront of what we do really matters to Ascendant. And for me, I really value that. And that's honestly why I decided to join them a couple of years ago.
Wonderful. It's been fun to watch the activity and the transactions and the pace of growth along the way. As we come towards the end of our time today, Dusty, I kick myself. I didn't ask you to opine for a moment on what the outlook might be. We're recording this very early Q2 of 2025. And so knowing that there's a several week delay, the shelf life of what you say may be aged and moldy by the time it comes out, but things are shifting fast. As you look at 2025, 2026, we have the agricultural cycle that's been down. There's been reduced farm income and farm expectations. Farmer sentiment tends to pop around a little bit, but farmer sentiment and farm income are a pretty good barometer of opportunities that ripple out throughout the supply chain.
Yep.
We've got, of course, Section 301 and tariffs and the new administration's approach to, tackling trade imbalances and a variety of other issues. All that being said, and I won't ask you to talk about tariffs specifically, but what are you all looking at and what are you advising your clients to prepare for in the next couple of growing seasons, both from a view on M&A opportunities or risks and how might distress in the system manifest for opportunities, but even like widening the aperture a little bit, what are you guys thinking about in terms of the opportunities for growth or the risks preventing growth more generally?
Yeah.
A nice simple question for you to close.
No, great question. And I think, my comments, Joe, are going to be, I think they're going to be true for a number of months or maybe another year or two. Just, when we think about 2025, even into 2026, we've been to a number of ag conferences as we start the calendar year and visiting with a lot of people as you typically do during this season. And the theme has really been distress and uncertainty. So that's the thing we're talking about is distress and uncertainty. You talked about farm income and, just the cycle that we've been through and we're in terms of just stress in the system. There's not a lot of margin opportunities. So, businesses and the cost of capital has come up from where it was, a few years ago. It's just harder to make a positive P&L at the end of the day for several businesses kind of in our system. So we're seeing stress. Some even going to the point of distress, and when they put their hand up and need some help, and lots of pieces of evidence around that from the small companies, to the announcements we've seen from ADM and Cargill, even with a number of layoffs and exiting business lines and those kind of things that we read in the headlines, on a pretty regular basis. It's universal across the ag system. Uncertainty, certainly, Trump's over 100 days in office now, and he continues to just rapid fire. All kinds of things from tariffs to uncertainty in biofuels policy that's been an underpinning of growth for the last several years in our industry with oilseed crush, investments to feed the renewable diesel and the sustainable aviation fuel, growth that we've seen coming and we've experienced. There's a lot of uncertainty around that now. So as we think about kind of advising clients, I think a really key thing is optionality. Make sure that, you have multiple ways to manage your P&L, opportunities to, increase revenue, to manage your costs, those kind of things around optionality in your supply chain. I'm a big fan of building trusted processes and kind of data-driven metrics, which I know is a big thing that you do, Joe. Kind of getting back to trusting your gut versus kind of reading what the data tells you. Same thing in your own business. Have clarity around metrics for how you measure your business and really trust the metrics, because sometimes it can be scary when you're in the middle of distress and uncertainty, and kind of relying back on some numbers I think are important. Obviously conserve cash. One of my favorite sayings is sales are vanity, profit is sanity, cash is king. You can look at your P&L, and even if you print a positive result, make sure you have adequate cash to kind of weather some of the storms that we're not through yet. They're still coming. There's storms on the horizon. And then the last thing, when I think about if I have people in my network that call me and ask me that question, there really is something to seeking good counsel and good advice. And it could be from Ascendant Partners or from whomever, but get good advice to kind of help you kind of read the market. I like to think about, one of my favorite proverbs is that with many advisors, plans succeed. I've always tried to get really good advisors around the table with me when I've been on the other side of the table. Or I watch the Masters. Masters was just on this last weekend. And, I like to think of the advisor's role like the caddy. We don't actually putt and strike the ball, but we help the golfer read the green. So try to have that caddy kind of in your corner with you, wearing your name on their back to help read the green as best as possible. So we're going to continue to navigate distress. We're going to continue to navigate uncertainty. And our industry's changing. We continue to evolve into this new biofuels world. That's not going anywhere. And our roles will continue to change. So it's going to be an exciting time. We see a lot of activity like we've talked about. There's a lot of things that are either happening now or wanting to happen. And a lot of it is because of this distress and uncertainty cycle that we're in.
Yeah, that's so well said. And I think about the parameters that you just walked through, maintaining some optionality in how you manage revenue and P&L, having those trusted, disciplined processes in place, knowing what the things are that you do to create value in your organization and doing them well, right? The kind of unsexy blocking and tackling of just running the business, conserving cash, of course, and fortifying your balance sheet, and then having that good, sound advice from multiple perspectives. Whether you're going to pursue an opportunistic or a strategic transaction in the next 24 months or not, all of those things just make you fight ready.
Right.
They just make for a lean, execution-oriented, resilient business that can lean into some headwinds and can survive in what could be some really challenging times, and maybe be under stress, but not tip into distress, to use that the phrase used earlier, right? And a final point there around the caddy. It's not just reading the greens; it's also a caddy that's been with you for a while. You don't have them show up the day of the Masters.
Exactly.
Right?
Yes.
They're with you for the entirety of the season or multiple years. Not only do they help you read the green, they know how you're going to play the green. They know what your capabilities are, and they can kind of coach you through that. And they also make sure that if you bogey in a playoff hole, they know how to coach you through that setback and keep your dauber up and maybe help you come out on the other side of it. And so I think that's really wise. Dusty, there's a couple of ideas for having you back for future shows, governance being one of them. But I just wanted to say thank you for the work that you do for the industry, both in your current role as well as over a number of decades now that you've been doing it. And again, as I said at the top, just thank you for taking the time to be part of the Pacesetter Pod today.
It's a joy, Joe. Thank you very much.
Wonderful. Thank you. And to our listeners, thank you again, as always, for tuning in to today's episode of the Pacesetter Pod. One request: if you found value in today's conversation, and I'd be surprised if you didn't, please consider sharing this with others in the industry that you believe would benefit from this conversation as well. This is the best way you can support the show and help to amplify the work that we try to do here every week to elevate thinking around strategy execution in agribusiness. Thanks for joining. I look forward to having you join us again right here on the Pacesetter Pod.
This is the podcastfactory.com.